Welcome to the Balance Sheet. I'm your host and fellow student, Conrad Chua. Today, we have Ellen Quigley, a research professor here at the University of Cambridge. Ellen is co-director of Finance for Systemic Change here in Cambridge, and until recently, she was also special advisor for responsible investments to Cambridge's chief financial officer. So welcome, Ellen.
Thank you, Conrad. It's a pleasure to be here with you.
Ellen, you've done a lot of work in terms of responsible investments and universal ownership. Could you start by telling us what is universal ownership?
Well, that's my favorite topic, Conrad, so I'm happy to dive right in. The idea of universal ownership basically reflects the fact that if you are almost any kind of asset owner these days, you will be broadly diversified. That doesn't mean, by the way, that you have to be perfectly diversified. But if you invest across various sectors and geographies, which is usually legally required, you own a more or less representative slice of the whole financial system. And that means that your returns very closely track those of the whole market. And the implication of that is that if the market goes down, so does your portfolio. Even if you outperform the market, most of your market returns actually come from market returns overall. So you have a strong interest in the performance of the whole financial system. Because if you're a pension fund or endowment, you care what the absolute value of your portfolio is many decades from now. And that means that if we have issues like climate change, that's a major global systemic risk that could have a severe impact on overall portfolio returns over the next few decades, then you kind of have to attend to that as a fiduciary. So what's interesting about universal ownership is that it is actually a financial argument for why we have to worry about systemic risks like climate change. And that has been reflected in, for example, the Freshfields 2 report that looks at 11 different jurisdictions around the world, including the UK and the EU, finding that not only is it permissible to look at those kinds of systemic risks to the portfolio and to try to have an impact on them in the real world, but that it might actually be required because, again, this is a financial argument. If you can't protect your portfolio from a systemic risk, which I would say is certainly the case, then you arguably your fiduciary duty runs towards actually having to contribute to reducing that systemic risk in the real world. In other words, doing something about an issue like climate change.
So, is climate change the only systemic risk that you think would jeopardize large endowments, pension funds?
No, and that's a great question. So there are quite a number of systemic risks, and a lot of them are actually interlinked in interesting ways. So I'll just give a couple of examples quickly. So if you look at, for example, biodiversity loss, the World Economic Forum has suggested that about 50% of GDP is reliant on nature. So that's a pretty big potential systemic risk. Biodiversity loss and climate change both exacerbate the other, and both of them actually increase the risk of zoonotic disease, such as pandemics like COVID-19, because the more you have incursions into natural spaces, the more you have interactions between humans and the mammals with which we can swap pathogens. So it's been very strongly linked, biodiversity loss and zoonotic disease, but also climate change and zoonotic disease. And of course, there's a lot of interplay among all of those risks. And those are just a few.
So one of the things that we learn in finance, or that our students learn in finance here, would be how do we break up like a portfolio, isolate risk, price that risk, see how we can hedge the risk in certain ways. Are you saying that for things, the impact of things like climate change, biodiversity, this is not something that asset holders can hedge?
That's exactly. It's what's called as, it's sometimes referred to as a non-diversifiable risk or an unhedgeable risk. So you actually have to think in a different way. You have to adopt some what people sometimes refer to as systems thinking. And it kind of means flipping around ESG, which is, it sounds probably a bit unusual, but basically ESG is linked to the idea that you could somehow kind of stock pick in such a way as to protect your portfolio or improve returns. What I'm saying is actually the opposite of that. It's acknowledging that you can't protect a portfolio from such significant long-term systemic risks, and that actually that sort of forces you into a mindset in which you have to do something about those risks in the real world. Because it's even if you vastly outperformed the market, if the market is doing very poorly, you can't pay out in absolute terms the pension funds to your beneficiaries, for example.
Would pension funds look around and say, well, because of these long-term systemic risk, we'll have to reduce the returns to our, to the pension holders over time? Would that be something that they would look at?
Yes. So increasingly, and it's absolutely fascinating to see how much of a shift there's been in the pensions world. And I will say there's a big difference between how asset owners are thinking about this versus their managers. But I just presented at a conference in San Francisco, the Council for Institutional Investors, and actually also recently at the RI Europe conference. And if you talk to asset owners, they get this. They are increasingly referring to themselves as universal owners, and they're increasingly worried about these long-term risks because, again, they have to think in the long term. There's no point in kind of optimizing for the short or medium term if what really matters is what you're able to pay out decades from now.
It's one of these things in finance where if everybody goes down, the financial managers keep their jobs because they're like, well, everybody's down. So if I'm down a bit, it doesn't, So is that kind of thinking prevalent among asset managers as well? Or do you feel that some people are thinking, well, we need to do something to improve our returns so that we outperform other people?
That's an astute question, Conrad. I think that what you just asked is actually the difference between the mindset of an asset manager versus an asset owner. And I'm not here to impugn individuals. It actually is about the incentives and the mindset that comes with both of those two different roles. And I think what I'm seeing among asset owners is this growing understanding that their mindset is quite different because the measures that we tend to impose on asset managers are relative measures, right? It's as you said, as long as you're outperforming your peers, you're fine, even if overall the activities of the whole system are actually reducing returns in absolute terms. So the asset owner has to worry about that, but actually for the asset manager, it's much more short-term and relative, and that's not their fault. It's how the incentives are set up in the system. And that's something that asset owners just have to be highly aware of. And they can drive what asset managers on their behalf are doing. It's just that I think only recently has that come to be understood more readily by the asset owner community.
Okay. So how does universal ownership work in practice?
So if you think about what you need to do as a universal owner, again, a lot of the things you might do will be kind of the opposite of ESG, because what you're looking for is to help decrease systemic risks in the real world. So you're going to worry about things like which of the companies in your portfolio are contributing to exacerbating those risks the most. So for example, let's say you own a large utility that's planning to build several new gas-fired power plants. As an asset owner, you actually really don't want that sort of thing to happen. So you will probably, on the public equity side, you'll engage in a number of stewardship-related actions. And we don't have time here to get into it, but this is, if you take my course, we'll get into the tools and tactics available to you on the public equity side as a steward to hopefully persuade the company that this is not the way to go. But on the debt side, you might decide not to participate in the bond issues, the new bond issues of a company that is engaging in that kind of fossil fuel expansion, because of course each one of those gas-fired power plants will run for decades. That's kind of locking in long-term emissions with each new one that's built. And for a utility, I mean, just to get nerdy for a moment here, your goal might be to actually influence the internal hurdle rate that that company is using to make the decision about whether to build new gas-fired power plants. And frankly, there is some evidence to suggest that the combination of kind of the threat of exclusion, especially frankly in the primary market, plus the engagement with that company, could be more persuasive. Because if you have a number of asset owners getting together and saying, we really want you to decarbonize to a company like that, and there might be an upfront cost to that. So if you can have that conversation so that they understand that their cost of capital might go up if they build the new gas-fired power plant, but it might go down if they adopt a decarbonization strategy, that kind of works out better for everyone. You do want a company that's serious about decarbonization to have a lower cost of capital, since a lot of the costs are upfront in doing that, even if in the long term it might actually be cheaper overall. In fact, it probably would be in this case. You would want to make that very clear to the company upfront so that there's a chance for them to take that other path in a way that doesn't, currently the incentives are not set up that way. It is actually just often easier to build that new gas-fired power plant than to do the alternative. And the idea would be for the owners to help ease that path.
So you've said a few times that universal ownership is flipping ESG on its head. But in this example, wouldn't a company or an asset owner that has ESG as part of its investment criteria, wouldn't they do the same thing, which is to discourage this utility from going down gas-powered power plants?
So currently, most ESG activity has to do with stock picking in public equity, which is not what you would bother with if you're a universal owner, because you don't think that you can protect your portfolio by altering your exposure on the public equity side. But what you understand as a universal owner is that there's a greater opportunity for additionality or impact on the fixed income side of your portfolio. So as an ESG investor, you might decide to tilt away from the company that's building new gas-fired power plants, even if you're looking at gas-fired power plants, which for an ESG investor, most of the tools available to people don't even tell you whether a company is building new fossil fuel infrastructure. So you probably don't even have that information on your ESG dashboard. And from a universal ownership perspective, you're much more likely to just, continue to hold that company as you would otherwise on the public equity side. And then any changes that you might make in allocation in security selection, you'd be more likely to do that on the fixed income side because you're more likely to have an impact. So, a lot of ESG activity is around disclosure and public equity tilts or exclusions, and those are very unlikely to have an impact on the company. So, for example, asking for disclosures from a company, usually the information you get back isn't very good. There's some information on that available as well. But even worse than that, even if you do get disclosures from them, improved environmental disclosure is actually weakly negatively correlated with environmental performance. So it's very difficult to say that.
How do you explain that?
I think that probably high emissions companies are disclosing in order to kind of get the investors off their back. So it's something they can give them that's easy. And frankly, that's most of what they're being asked. So probably the types of the types of companies that are being asked to disclose are the higher emissions companies as well. So it really goes to show what they're being asked. So they're probably, some of them are more likely to be doing that because they're being asked. But certainly it can't be said that disclosure is associated with improvements in environmental performance.
And Ellen, you've done a lot of work on greenwashing as well. Is this idea of disclosure sort of inadvertently playing towards greenwashing, where the high emitters maybe want to be more transparent, and then they can show. In fact, there's probably an incentive to even overstate that in the beginning, and then over time they'll be able to show improvements. Is that the state of greenwashing at the moment?
Yeah, that is one aspect of greenwashing currently. But actually, I've written a couple of bingo cards to help people identify the most common
Oh,
forms of
okay.
green. Yeah. So we covered that in my class. It's I don't blame people for falling for the greenwashing that we see these days. Sometimes it's quite sophisticated. You do need to have spent as much time as I've spent combing through disclosure statements to be able to catch many of these loopholes and evasions. It's a whole industry. It is very sophisticated. So that's one example. You might expect, I mean, again, this is logical. You would think that if a company is disclosing more, I mean, we have a whole bunch of sayings in the English language, things like sunlight is the best disinfectant, what gets measured gets managed. So I don't blame anyone who thinks that more disclosure is better and that it's more likely to be linked to positive outcomes. And there are a whole bunch of things like that once you dig in, where your intuition is actually leading you in precisely the wrong direction. So there are a lot of elements of greenwashing that aren't obvious to the naked eye, and I think we need to up our game in this respect. I'm very practical in my approach. I want to see what the main sources of emissions are, and how you can actually detect that in the real world. And unfortunately, if you look at the indicators that we're using, including in many of the products and dashboards and initiatives that are prevalent in this industry, sadly, you end up marking off a lot of squares on the bingo card.
Oh my. How many bingo cards do you have?
I have one for banks and the other for asset managers. And part of the reason that I focus at that level is that that's where you as a universal owner can have the most leverage, because if you do engage with an asset manager or a bank, you can be engaging on all of their assets, which can cover off a lot more than your own portfolio would cover off. And yeah, that'll almost always be the case.
Okay. Okay. My own mental bingo card is any product that says it's carbon neutral.
That's one
So
there.
oh, is that one there? Okay, okay. Because I wear this Apple Watch and they say it's carbon neutral with with certain bands, and I'm like, that can't be right.
Your instinct is spot on, Conrad. We actually have many studies now finding that most offsets, which is usually what they're referring to, do not actually reflect the carbon absorbed by the underlying projects. So a couple of studies have found that more than 90% of these projects do not sequester the carbon promised. So that is certainly one of the items on the bingo card.
Yeah. Obviously, there's a big backlash against ESG in the US, and that's driving a lot of asset managers' behavior. You know, when certain states have basically banned any kind of mention of ESG. Do you think that's going to seep into the kind of talk about universal ownership at some point?
I think it already is. So
Mm.
one of the things that we've seen is that it's made people think in a lot more precise way about what they mean by ESG. And it's, I think, galvanized some of the asset owners who recognize that, I mean, this isn't airy fairy optional stuff. This is the health of their portfolio in the long term. These are real systemic risks. I mean, every reputable financial organization in the world now acknowledges that. I don't know of any, even large bank or asset manager that doesn't acknowledge climate change as a risk, even if they're starting to support many of the shareholder resolutions that they would have, if they're starting to oppose many of the shareholder resolutions they would have supported a few years ago. By the way, shareholder resolutions are a relatively ineffective way of getting things done in this regard. So this is another of the considerations you need to have as a universal owner. But so I would say that this is sharpening the thinking of a lot of asset owners who are starting to recognize that a lot of the things that they were doing before kind of in the ESG vein weren't that effective anyway. But also, I mean, it has been wrapped up in this kind of critique of wokeness. And I think it's starting to get some people to think about how they can be more hard-nosed about this. It's how to think about, again, these long-term financial risks. I mean, it is within the bounds of fiduciary duty now, as confirmed by quite a number of again, mainstream experts. So that's I think helping to get us past some of the more woolly thinking that informed the ESG industry. And by the way, a lot of the ESG industry features and approaches were developed by the asset management industry. And I think this is giving the asset owner community a chance to say, actually, we're going to articulate what we want and need, and then set out those expectations for our asset managers. And by the way, asset managers who want to get ahead of this would best look into universal ownership and its implications, because it is pretty clear to me that that's where things are going.
So if I go back to your example about the gas-powered power plants, gas-fueled power plants, I think implicitly you're saying it's much easier in the short term to build and finance, or to finance the building of a gas-fueled power plant versus something like nuclear or something, which is maybe longer term. So is that the case that asset owners are going to have to sacrifice a bit of short-term gain to be able to protect their portfolios in the long run?
That's a really interesting question, and I'm glad we've come back to that example of the utility. So there are a couple of things here. One is already it's the case that it's cheaper to build renewables than coal in all major markets, and in nearly all major markets, it's at least about the same cost-wise to build a new gas-fired power plant as it is to build renewables. But one of the big differences is that a utility is more likely to know who to call to build a new gas-fired power plant. They're much more familiar with the permitting process, the supply chain. They're more likely to have the skills and so on available to build that new plant. So what you need to do is to get people to kind of have an impetus to get over those hurdles. So it's not all about the cost, although if the cost does start to show up meaningfully in their hurdle rate calculations, then they kind of have to do the extra work to figure out what their supply chain and permitting and all that process will actually look like. So that's the kind of way in which we would hope that universal owners could help people kind of get over that initial barrier. So just to say, I mean, the cost, I mean, renewables really are that competitive now. And a lot of the companies that are building new gas-fired power plants actually already have quite a lot of their power supply coming from fossil fuels already. So it's not like a grid balancing problem yet in a lot of these cases. So you would hope that with the combination of that kind of financial imperative, as well as a very clear message from the ultimate owners, that they might start to make different choices. And again, that could end up protecting them from a lot of other types of risk in the longer term. So you might be familiar with some of the advances in attribution science that have come through in the last few years. Attribution science basically just allows you to attach the costs or harms of, let's say, a major extreme weather event to the emissions of a particular company. And why that's significant is that that feeds directly into litigation. So we're starting to see attribution science play a role in court cases against individual companies who then can have damages assigned to them through these scientific advances. And by the way, with gas-fired power plants, there are also major advances that have been made in terms of the detection of methane leakage. And why that's important is that once you account for methane leakage, gas-fired power plants can actually have worse emissions in some cases than coal-fired power plants, especially if they're being run off of LNG, so liquefied natural gas, as the input. In that case, it very likely will be higher emissions than coal. And frankly, as extreme weather events get worse and worse and worse, you would expect to see more litigation and frankly regulatory pressures as well, because people are going to become more and more angry and fearful as wildfires and droughts and extreme weather events continue to worsen.
So do you see like asset owners being the ones who are going to be the plaintiffs and bringing this sort of cases to court? Because if you're an insurance company, for example, and you start having to pay out all this climate related payouts, right? Are you seeing interest in those kinds of people in attribution science?
I think we will see a range of plaintiffs, and that's already starting to happen. We could have plaintiffs who are, people living near the power plant. Governments could sue company. I mean, we've seen that in the past with tobacco, for example. That's the thing, is litigation risk kind of comes from all directions, including the ultimate owners, but also others. So, and indeed, we've seen a really dramatic increase in climate-related litigation over the last many years, and that trend appears likely to continue.
So, Ellen, you've mentioned a few times how things like shareholder resolutions aren't very effective. Does that mean that you're not a big fan of engaging with corporate boards because it doesn't get us closer to the goal of managing systemic risk?
I am in favor of engaging with corporate boards. I just don't think shareholder resolutions are the best way to do that. And I say that on the basis of having read more papers than I care to mention that look at the actual connection between shareholder resolutions and concrete outcomes on the part of the company. So, if you look at the evidence, you will come to counterintuitive conclusions about which the best approaches, tools, tactics to use are. And that's, I think, what keeps me excited about this space, is how much doesn't end up aligning with your initial intuition. And that is why part of the reason that Cambridge's approach to this whole space has been so original, because we are allowing the evidence to inform practice and practice to inform the evidence. We've had this really interesting interplay between those two things, which is not common in the industry and has helped us to do things that are pioneering.
So what, from the evidence, what actually works?
Well, you have to take my class for that, Conrad, because it takes quite a while to cover. But I'll just put it this way: the evidence does suggest that it is a combination of tactics that is more likely to work than any single strategy in and of itself. And so I can kind of cover some of what those strategies are across asset classes, and preferably people will use them in combination for a greater chance of success.
So what is one thing that Cambridge has done that's been evidence-based and very different from the prevailing wisdom?
So there are a few things I could pull out as examples. I'll maybe just point to two. So one is a collaboration with 78 higher education institutions across the country. And we put out a request for proposals for the cash space, because we noticed that there was nothing out there for example, money market funds that did not contribute to fossil fuel expansion, for example. So one side of the RFP was looking at banks. We actually expect to be able to announce in the next couple of months that there is a full service bank that has gotten out of financing of fossil fuel expansionists, which is brand new and will allow, for the first time, municipalities, universities, any other institutions that are concerned about these kinds of issues to actually switch over all of their banking services to a single provider who can cover off all of the things that they need. So that is very exciting, and is certainly, so there are a bunch of different pieces of evidence that fed into that, but one of them is that collaborative engagements are more likely to produce results than single entity engagements. So that's why we pulled together all of our peers in this way. That's been a fabulous collaboration. The other side of the RFP, we will actually end up creating the first money market fund equivalent that we know of that does not contribute to fossil fuel expansion. And actually, we'll be announcing that very soon. So by the time this video comes out, that should be already in the public sphere. And then I suppose the other thing, and this is very unusual for a university to do, we're launching a bond index that will be named after the University of Cambridge, that Cambridge will be a seed investor in. And that is based on a peer-reviewed academic article that I put out a couple of years ago that lays out the design and the evidence base behind it. So that's very exciting. And again, universities don't normally do this, and it really emerges out of the experience and research base that we've been developing over the last many years.
So, Ellen, can you talk a bit more about the bond index? Because that I know has been announced and was covered in the Financial Times as well. Why did you think that a bond index would be a powerful tool for investors, for asset owners?
Thanks. Yeah, I mean, I love talking about the bond index. It emerged in large part because Cambridge couldn't find an available off-the-shelf option for when it needed to start its liquid multi-asset fund many years ago. There was just nothing out there that was on the bond side that aligned with the university's approach. And I think one of the main insights out of some of the work that we had done prior to that is that actually, if you're looking at fossil fuel expansion, so I mean, just to back up, fossil fuel combustion accounts for the vast majority of human-caused emissions. So you really have to focus on fossil fuel combustion if you want to do something about climate change. And it turns out that about 90% of the new capital flowing into fossil fuels comes from debt. So bank loans and new bond issues. But people don't tend to really pay attention to that. Again, the ESG space has been overwhelmingly focused on public equity exclusions and tilts and so on and so forth. And there's been historically very little available on the bond side for investors. So we do a lot of work putting pressure on our banks as a university, and that's been the main focus of a lot of our engagement efforts. But on the fixed income side of things, we really needed a bond product that would be, cheap off the shelf, and that did not include all these companies that are building new fossil fuel infrastructure or exploring for new reserves. So we decided to create our own. And I don't have enough time to get into all of the design elements, but I just want to say what goes into the design is things like, there are several studies now suggesting that the threat of exclusion from an index is associated with a better response from the engagement efforts that you are undertaking with those companies. So those studies have only looked at public equity, where the impact on a company's cost of capital is very unlikely. So the hypothesis is that if you have the threat of exclusion from a bond index, where there's a potential implication for both the cost of capital and the volume of capital you can raise, that then the impetus behind the engagement that you have with those issuers should actually be stronger than it is on the equity side. And again, we already have evidence on the equity side that companies are more likely to accede to the requests of engagers when there is the risk of falling out of an index. So there are a bunch of different design elements like that that went into how we designed the bond index. And by the way, it's overseen by an academic board with academics from all over the world. We chose an index provider that has particular expertise in this area. And we have pre-launch commitments of already 750 million, which is quite a lot. And Cambridge is one of those seed investors. So again, I guess to get into all of the detail behind the design and also the other things that Cambridge has been doing to kind of pioneer a new approach to responsible investment, we would cover all of that in my class, so that people understand all of the reasoning that went in.
So before we talk about your class, does this mean that without this bond index, right, someone like Cambridge or a pension fund, if they wanted to do what you mentioned, they would have to develop a lot of in-house capabilities, go through a lot of time and effort to examine each and every debt issuance. But now with this bond index, they can just take that as and all that work is done. Is that how it works?
So currently, I mean, what Cambridge ended up doing was, they had to pay an asset manager to do something bespoke for us, and that costs more.
Mm,
But the funny thing is that there's a flip side of that as well, which is that if you have a whole bunch of investors getting behind the same product, that should strengthen the asks behind the index itself. Because one of the
mm,
problems in this um, ESG space is that people are asking different things of different companies. And, to be fair to the
mm,
companies, it's actually difficult to know which things you should act on. This is hopefully aligning a whole bunch of investors behind the same methodology. It's an open access methodology, by the way, so people can use it for other purposes. They don't need to be invested in the index. And the idea is to get people focused on the indicators that actually matter and what the companies really
mm,
would need to do to have a big impact.
mm. So it works for companies as well as the asset owners, the people who are investing. So it's kind of a nice confluence of incentives.
You could say.
Yeah. So Ellen, you teach an elective here at the business school. Can you tell us a bit more about what you cover in that class?
Well, rather helpfully, Conrad, you've already asked me about many elements of the course. So it's basically like a deep dive, a crash course into issues like universal ownership, greenwashing, divestment. By the way, divestment is a lot more complex than people usually conceive of, and has a different purpose than people normally conceive of, as well as these the greenwashing in the financial sector looks a little different from the greenwashing in the kind of real economy sectors that people will often refer to. But frankly, a lot of the things that you would learn in terms of greenwashing in banking and asset management also translate into sharpening your gaze when it comes to real economy companies as well. So we cover off issues like offsetting, green, blue, pink, whatever, all the colors of hydrogen, and so on and so forth, giving a real nuanced view of where certain technologies should be used and why, and what the cost implications are, as well as emissions, and so on and so forth. So I'm deeply practical in my approach. I hope that students come away with a real sense of what they can concretely do as an investor to address systemic risks like climate change, but also how they can be more discerning in general. We're all investors as well. We all have pensions or private investments that can be informed by many of these learnings as well. So it's kind of deeply practical. And frankly, the other thing that I like to do in these classes is to pull from what students want to learn about most. So we kind of dig in where there is particular interest. When the students say, I'd like to learn more about this, I often, go home, look into it a little more myself, so that I can bring that into the next class as well. I like to be responsive and to reflect what's happening in the news at that time as well, so that we can be as up to date as possible. So that's kind of the approach. It's flexible but practical at the same time.
And Ellen, who should take this course?
The course is particularly useful for anyone who works with asset owners. So that can be because you work for an asset owner organization or plan to yourself, but also anyone who works for an asset management firm, so you can get ahead of where things are going, insurance companies, banks, so anyone in the financial sector, but also anyone who just wants to be able to engage more fully with their own service providers or their institutions' service providers in the investment and banking realm. So basically, it's kind of open to anyone, but particularly those who are in the financial sector.
Right. And how much, say, technical knowledge or experience should a student have before they can come on the course?
You can start with nothing. And actually, I would say that it's almost an advantage not to have been drenched in ESG thinking before approaching
Okay.
more of a systems focused class like this.
Mm. Okay, great. Well, Ellen, thank you so much. And I hope that students who are watching this will be interested and sign up for your elective.
Thank you, Conrad. Great questions. So it's been a real pleasure to speak with you.
Thank you very much.